Hello again, everyone. This is the practice problem video for Chapter 9, all about flex budgets and some performance reporting. So I was going to start here with exercise 9-1 from your textbook, preparing a flexible budget. And the setup here said Puget Sound Divers is a company that provides diving services such as underwater ship repairs to clients in the Puget Sound area. The planning budget for May is shown here in the box. So we had budgeting diving hours. It's our activity or volume at 100. We see the revenue there. It looks like we're billing customers, or expected to be billing customers, $365 per diving hour. And we've got wages and salaries expenses, supplies, equipment rental, insurance, and some miscellaneous. So after that, it said during May, the company's actual activity was 105 diving hours as compared to the 100 that were planned or expected. So using Exhibit 9.5, which you don't need to look at right now, but you can if you want, separately as your guide, we're going to prepare a flex budget here for May. So fundamentally, as you read about in Chapter 9, the flex budget takes that planning budget and flexes it, if you will, to account for differences in activity or volume when comparing what we actually did versus what we expected to do. In other words, we're trying to answer the question, what should revenue and expenses have been given what our actual activity level was? So I kind of sketched out a rough flex budget here in Excel, and I just wanted to not fill in anything before I started talking about it. Let's go ahead and add the diving hours at the top here, keeping in mind that that flex budget, we can prepare it at really any level of activity. We can do some what-if type scenarios with it as well. But for our purposes, we're primarily flexing it to that actual level of activity. So this would be the 105 diving hours that were actually worked or billed to customers, rather than the 100 that we expected to do. Okay, so top line here is revenue. Again, the revenue formula was $365 per diving hour. So if we want to flex revenue to the actual level of activity, we'll take $365 per hour times the 105 actual hours that we dove. So there's our revenue at $38,325. Now, wages and salaries we saw in the planning budget was a mixed cost, right? There's a fixed component, $8,000, maybe salary for, the company owner, manager, whatever, plus $125 per diving hour. So in our flex budget here, we're just going to flex that to the actual level of activity again. So we'll have the fixed wages and salaries of $8,000 plus $125 per diving hour, again times those 105 actual diving hours. $21,125. Similar idea for our other expenses here. Supplies was $3 per diving hour, and that's so truly a variable cost, moves in direct proportion to changes in activity. So when we flex that, we've got $3 times 105 actual diving hours. Equipment rental, that looks like it's mixed, right? We've got a fixed component here of $1,800 plus the $32 per diving hour, again times the 105 actual hours. Now insurance looks like a fixed cost, right? Just $3,400. So remember, we don't flex fixed costs in a flex budget. By definition, those things are assumed to be staying constant regardless of changes in volume. So we're not going to flex those. So insurance would just be that same $3,400. And then finally, miscellaneous looks like it was mixed as well. So we've got $630 here, plus $1.80 per diving hour. So times the 105 actual diving hours. And there we are at $819 for miscellaneous. So total expenses, we're just going to add up all of those individual expenses. And I'll just use the sum function here, since this is just a quick calculation. So total expenses $30,819. And that would leave us with net operating income. Here I'll do the numbers explicitly. Revenue of $38,325 minus total expenses of $30,819. So net income in our flex budget, $7,506. And there is sort of a built-in logic check for us in the sense that our actual activity here was greater than our expected activity, 105 hours versus 100. So everything that moves with activity should be higher in that flex budget. Right? Revenue should be higher. Any expense that has a variable component should be higher or greater, and net income should be higher or greater as well. So just kind of a built-in check for us there. All right, I am going to move on to exercise 9-4. And again, I've sketched out a little bit of a shell of a performance report here just to help us in terms of getting stuff laid out. So 9-4 said Vulcan Flyovers offers scenic overflights of Mount St. Helens, that volcano out in Washington State there that erupted 40 years ago. Data concerning operations in July were shown for us. So we had the actual results, activity, revenue and expenses to come up with net income. We also had what appeared in the flex budget and what appeared in the planning budget as well. Now it says the company measures its activity in terms of flights. Customers can buy individual tickets for overflights or hire an entire plane for an overflight at a discount. We're going to prepare a flexible budget performance report for July that includes all of our variances from Chapter 9. So our revenue and spending variances and our activity variances. That's why I haven't pre-filled any of this stuff. I wanted to make sure it was kind of as clear as could be. And then we'll worry about this second part. Okay, so let's go right to left here. Let's fill in some information for our planning budget. We expected to service 50 flights. We expected before the period ever started to collect $16,000 in revenue from those flights. Our expected wages, $8,100, fuel, $11.50, airport fees, $25.50, depreciation, $350, office expenses, $290. So total expenses there, $12,440 for net income of $35.60. Now the flex budget, as we spoke about in the earlier exercise, should really be prepared for this purpose at that actual level of activity. Right? We're trying to level set here so we have a basis for an apples to apples comparison of what revenue and costs should have been, at least in theory, based on what our actual activity level was. Okay, so our flex budget here at the actual level of activity, in this case of 48 flights. Now that revenue number, just to be clear, it's given for us $15,360. But that is the revenue formula, this expected bill rate of $320 per flight, times the actual number of flights served of 48. Okay, so that's how we got that number there. Wages and salaries, similar idea. That's a fixed cost, or excuse me, mixed cost. So it had a fixed component, I should say, $4,000. Plus $82 per flight times, better put that in parentheses, $82 per flight times the 48 actual flights we served. Okay. The rest I'll just fill in here. So fuel was purely variable. So $23 times the 48 flights, or $11.04. Airport fees looks mixed. Depreciation, we've got variable piece there. Office expenses mixed, so total expenses $12,136 for net income of $32.24. Now let's think about the variances that come into play if we compare that flex budget to our planning budget. The only difference between a flex budget here and the planning budget are differences driven by changes or differences in the levels of activity. Our actual level of activity versus our expected level of activity. Okay? So that's why we call these things activity variances. Let's figure out what these are. So for revenue, we'll take the difference between the planning, $16,000, and the flex, $15,360. That's a difference of $640. this is a revenue item, so the flex is lower than the planning, we'd say that's unfavorable. We want to think about the effect on potential profitability when we make that determination. If it's a quote-unquote bad thing for profitability, then it's unfavorable. If it's a quote-unquote good thing for profitability, it's favorable. Also keep in mind, it's worth saying, and I'll probably say it again at some point too, so I apologize in advance for being a broken record, but activity variances, we do make these unfavorable and favorable determinations, but it's important to keep in mind this doesn't really tell us that it is necessarily good or bad. It just means that's the expected difference given our change in activity. In other words, we served 2 less flights than we expected to, so yeah, our revenue, should be lower. It's unfavorable because that would be the ultimate effect on profitability, but this isn't an unexpected difference at all. Okay, so wages and salaries here, let's find a difference there. 8,100 in the planning, 7,936 in the flex, difference of 164. This is an expense item. Flex is less than planning, so we say that's favorable. And again, same deal there, right? Favorable almost makes it sound like a good thing, but expense is only lower than expectations because we served fewer flights. We had lower activity. Okay, it's not necessarily a good thing overall when we consider all of these changes, right? We hopefully, have more demand than we expected. That'd be the ideal. Okay, cruising right along then. Fuel, we had a small difference here, $11.50 minus $11.04, $46. Again, that's favorable. Oh, built-in logic check for us here, by the way, not to derail. If we have less activity than we expected, all of our activity variances for expenses for anything that has a variable component will be favorable, right? Expense has to be lower because we had less activity. If actual activity had been greater than planning, these would all be unfavorable for things that change with activity. And then the reverse would be true for revenue. All right, airport fees, $25.50 minus the $24.74 or $76. Again, favorable. Got a small difference here in depreciation. Just to be explicit, I'll punch in the numbers there, $14. That's favorable. Just a few bucks for office expenses, $4 in total. Again, favorable. And then total expenses, since we've got the totals, I'll just do that math separately. $12,440 minus $12,136, $304 favorable. Now for this, if we, for some reason, needed to back into it or had some missing pieces, we could net out the individual expense variances to get to this. Okay, and then finally, net income, $35.60 minus $32.24. There's a difference of $336, and that, the flex, less than the planning, so that is unfavorable. Okay, we also could net out this revenue activity variance and the total expense line activity variance there to get the same answer. It's $640 unfavorable minus $304 favorable would leave us on the unfavorable side by the difference of $336. Okay, let's move over and look at our actual results here. So we did serve 48 flights. Our actual revenue billed to customers was $13,650. Wages and salaries $84.30, fuel $12.60, and so on down the line as given. Now these things, keep in mind, when we say the actual result, we're talking about, essentially tabulated receipts. So all the bills I sent to customers, revenue I not necessarily collected, but at least billed to them, that's my $13,650. There's no formula to come up with that, in other words, based on what actually happened. Okay, so if I compare my actual result, reality, to what revenue and expenses should have been, given what my actual activity was, now the difference here then has got to be related to something other than activity differences, right? This is my revenue and spending variances. I know that's going to get cut off here, but there we go. Right? In between our actual and our flex, our revenue or spending variances. Any difference here coming from something other than a difference in activity. because these are at the same activity point. Okay, so let's look at revenue first here. We had 15,360 in the flex budget versus 13,650 in our actual result. So we got a difference of 1710. Actual is less than flex. This is a revenue item, so that is unfavorable. Okay, for some reason we billed customers less than we quote unquote should have, given the actual number of flights of 48. Now maybe in this case, they did give us a little information here and said customers can buy individual tickets or hire an entire plane at a discount. Maybe we had, more customers doing that than originally expected or planned for. Maybe we had to cut some other kind of discounts for, delayed service or reschedules or whatever else. Okay, wages and salaries here. We had 84.30 in the actual versus 79.36 in the flex. It's a difference of 494. The actual is greater than the flex. This is an expense item, so that's also unfavorable. Okay, we spent more on wages than we should have given our actual activity level. Maybe we had unexpected raises we had to give to, some of our staff, something like that. They feel we've got a little difference here, $12.60 versus $11.04, $156. Now actual is greater than the flex, so again, unfavorable. And that's probably related to fuel prices, right? Certainly the price of all types of gas fluctuates quite a bit at certain times, so it could be related to something like that. Okay, airport fees, 2474 minus 2350. And by the way, I tend to be in the habit of taking the smaller number from the bigger number, just so I don't have messy signs in here, plus or minus, and then just worrying about whether it's favorable or unfavorable. But you do, however, you kind of find best to keep track of these. So there's a $124 difference. Actual is less than the flex, so this one is favorable. Airport fees a bit lower than we thought they should have been given our actual activity. Depreciation was 336 versus 336, so no difference there. And then office expenses, we had a difference here, 460 minus 286, $174. Actual is greater than flex, so that is unfavorable. Okay, and then let's do the total expense line here. Again, we could net out the individual expense variances if we wanted. Since we've got the total, probably easiest just to do that. 12,836 minus 12,136 for a difference of 700. Actual is greater than flex, so there's unfavorable spending variance there at the total expense line. And so net income, we can see we've got a pretty significant difference here. 3,224 minus 814, 2,410. Actual is less than flex, so that's unfavorable as well. We also could have gotten that by taking this revenue variance and netting it with the spending variance for total expenses. 1,710 unfavorable, 700 unfavorable, so combine them, and there's our 2,410. Okay, part 2 there said which of the variances should be of concern to management, explain. There's no 100% right or wrong answer here. One thing we'd look at if we start with kind of the activity variances, we know what that's really all about, right? We know that we served fewer flights than we expected to. So I don't want to say the activity variances are never of concern, but it's really the activity that drives that, right? Why did we service fewer flights than expected? It's not an enormous difference. In fact, in this case, it's somewhat immaterial, but just something for us to think about. On the other hand, if we look at the revenue and spending variances, there certainly are some things that jump out. Right off the bat, that revenue variance of 1,710 unfavorable, that's a pretty big deal, right? That's more than 10% of our expected revenue. So why were we having to discount flights so much, right? Again, was it scheduling issues that were caused by us? Or was it scheduling issues caused by bad weather? And for some reason we give discounts for that. We certainly don't know given the details here. but this one would be of concern to management. Some of these spending variances might be as well. And the wages and salaries one, potentially significant there. It's kind of 5% of the expected cost. Just want to make sure we understand where it comes from. We know for sure it doesn't come from the change in activity, right? We've already accounted for that here with our activity variance. So where is it coming from? Was it unexpected raises? Was it change to payroll taxes, something that's completely outside our control? Who knows? So just a few things to kind of think about there. All right, I wanted to take a look next at exercise 9.5, actually right below 4 there. 9.5 said, ACCT Tours operates day tours of coastal glaciers in Alaska on its tour boat, the Blue Glacier. Management has identified 2 cost drivers, number of cruises and number of passengers that it uses in its budgeting performance reports. Published a schedule of day cruises that it may supplement with special sailings if we've got demand for it. Up to 80 passengers can be accommodated on the tour boat. Here's the company's cost formulas. So we know the fixed cost per month, the cost per cruise, and the cost per passenger for vessel operating costs, advertising, admin costs, and insurance. And it just said, for example, vessel operating costs should be $5,200 a month, plus $480 per cruise, plus $2 per passenger. Now, sales should average $25 per passenger, so that's ticket price essentially. And in July, the company provided 24 cruises for a total of 1,400 passengers. So we're going to put together a flexible budget for July here for ACCT Tours. This is 4-month ended 7/31. So let's start off with revenue. Now our ticket price is expected to be $25, so the flex budget would reflect total revenue of $25 per ticket times the actual number of passengers we served, which they told us was 1,400 there. Okay, so revenue should have been, quote unquote, $35,000. Now let's look at some expenses. First up, we had those vessel operating costs. Now these have 3 components, a fixed component and then 2 variable components, one for each of 2 separate cost drivers. So vessel operating costs in the flex budget would be $5,200, the fixed piece, that doesn't change based on any level of activity with the cruises or passengers, plus $480 per cruise times the 24 cruises we served or ran, plus that third component, $2 per passenger times the 1,400 passengers we served in that same period. So very similar to our early example of creating the flex budget, we're just now accounting for more than one cost driver. So there we are, $19,520. Next up was advertising. That has a fixed component of $1,700 per month, no variable components for either cost driver. As we know, in a flex budget, we do not flex fixed costs. We assume those are staying, the same in total. So $1,700. We had some admin costs. That had a fixed piece and then variable pieces per cruise and per passenger. $4,300 was the fixed piece, plus $24 per cruise times the 24 actual cruises we conducted, plus $1 per passenger, and again we had 1,400 total passengers in this month. So there's our admin cost, $6,276. Finally, we had insurance. Looks like that was fixed, $2,900. So again, we don't flex that in the flex budget, just leave it at $2,900. And there we are. Oh, real quick on fixed costs. I know I said this earlier, or hopefully I did, but fixed costs, then we can never have an activity variance for those. So we look back at our flex budget performance report from 9.4. cannot have an activity variance for fixed costs. Now, we didn't have any fixed costs in that example, but nonetheless, no activity variance for them because we don't flex them. We can certainly have spending variances for fixed costs, though. Always want to keep that in mind. All right, so total expenses here. I'm just going to get a quick sum of those 4 individual expense items. They were at $30,396. So net operating income would be the $35,000 revenue minus the total expenses there, $30,396. And there we are at $4,604. So again, just taking this kind of one step further or differently by incorporating more than one cost driver. Okay, that really does cover the main components of Chapter 9, the big ticket items, but I am going to work through the foundational 15 for this chapter as well. So if you feel like you need a little more practice, by all means, kind of stay with me here. The foundational 15 at the back of your chapter before the exercise is also plugged into Connect, if you want to look at it there. So this said AgiCorp is a service company that measures output based on the number of customers served. We've got the following fixed and variable cost estimates that's used for budgeting purposes, and the actual results for May as shown here. When preparing the planning budget, the company estimated it would serve 30 customers a month. However, during May, we actually served 35. So let's worry about these 15 items. So first, said what amount of revenue would be included in the flex budget? So I'm going to go ahead and sort of anticipate. If we kind of glance down, they're going to ask us about the flex budget, some variances, some actual numbers, and then some numbers from the planning budget. So I'm going to kind of throw all these together here. So I'll leave a space for the planning budget, the flex budget, and then the actual results. In fact, let me move this over real quick. All right. So number one, what amount of revenue would be included in the flex budget? Let's go ahead and just pop that right in here. Now for revenue, we know the variable element per customer is $5,000 and there's no fixed piece. So $5,000 times for the flex budget, the actual number of customers served of 35, and we'd have revenue of 175. And then it said what amount of employee salaries and wages would be included in the flex budget. So let's think about some expenses here. Salaries and wages had a fixed component of $50,000, so we wouldn't flex that. We'll add to that though, the variable piece, $1,100 per customer, flexed to, again, the actual level of activity, 35 customers. And there's our wages and salaries in the flex budget. Now we also want to know travel and other. Those are the next two here, also in the flex budget. So let's go ahead and pop those in. Travel is purely variable, $600 per customer. So 600 times the actual number of customers of 35. And there's our travel expense in the flex budget. And then other expenses, those were all fixed. So we don't have to flex those at all, $36,000. Now finally, 5 said what net operating income would appear in the flex budget. So let's do this. Let's get a total expense line and then net operating income just to kind of be somewhat consistent. This is the sum of our 3 expenses. And so net operating income would be that revenue of 175 minus total expenses 145,500. Now, number 6, this is why I like doing this problem too. It causes us to think about things from a different direction or in a different order. 6 said, what is Adger's revenue variance? Revenue variance. Now, be careful here because we have an activity variance for the revenue item and we also have a revenue variance. The revenue variance comes from comparing the actual result to the flex budget. Okay, in other words, we're saying what difference do we have in revenue caused by something other than a change in activity? Okay, so I've got to compare my actual to my flex. Actual revenue was $160,000. So the revenue variance, this is revenue and spending variances in this column. Revenue variance here, difference between the flex budget revenue of 175 and that actual revenue of 160. So $15,000. Now actual is lower than flex. This is a revenue item, so that would be unfavorable. Now the next three items want us to come up with the spending variances for salaries and wages, travel, and our other expenses. So we'll be staying right here in this column, comparing actual to flex. So let's punch in the actual amounts here for our expenses: 88,000, 19,000, and 34,500. You know what? Let me finish that out while we're here. Total expenses then of 141,500. Net operating income, revenue minus total expenses, 18,005. All right, so wages. Flex was 88.5, actual was 88. So we've got a difference of 500. Actual is less than flex, so we'd say that's favorable. Okay, for travel, we've got 21,000 in the flex, 19,000 in the actual. So there's our difference of 2,000. Actual is lower than flex, so once again, favorable. And then our other expenses here, we've got 36,000 versus 34,500. $1,500 difference. Actual is lower one more time, so we are favorable again. Now at the total expense line, it's not asking us for this explicitly, but I'm just going to fill that in since we're here. 145,500 minus 141,500. That $4,000 difference is favorable. Also could net these out to get the same thing. And then at the income line, just for completeness, 29,500 minus 18,500. There's our difference of 11,000. The actual is lower. This is income line. So this is unfavorable. It's also the net of our revenue variance and our spending variances for all of our expenses. Okay, now back to our numbered items here. Number 10 asked what amount of revenue would be included in the planning budget. Remember, our planning budget's prepared at the expected level of activity. Because we're doing it at the beginning of the period, we don't know what actual level activity we're going to be serving. So what we're going to do there is take our revenue formula. It's supposed to be 5,000 per customer. And we're going to multiply that by our expected or estimated level of activity or customers of 30. So it'd be 150,000. Next up, 11 through 13 here, we wanted the expense items in the planning budget. So we're going to do those right here. Wages, again, had a fixed piece of 50,000. So to that, we'll add the 1,100 per customer variable piece times the 30 estimated customers that we had expected to serve. Travel, similar deal, 600, it's variable entirely, times the 30 customers we expected to have. There's 18,000. Other was entirely fixed, 36,000. So that's how it would have appeared in the planning budget. And then again, I'm going to fill in the totals here just for sake of completeness. They didn't ask us to do that. It would look odd if we didn't, I suppose. Now the last two items wanted to know what activity variance would we report with respect to revenue. Okay, so that's comparing our flex budget revenue to our planning budget revenue. 175 versus 150. That's a difference of 25,000. Flex is greater than planning. It's a revenue item, so we'd say that's favorable. And don't forget our little logic check here. We served more customers than we had expected to or that we had planned to, so we should have a favorable activity variance for that period, for revenue. Oh yeah, and then it wanted to, for each of its expenses for 15, so let's fill in these here. So wages, 88,500 minus $83,000. It's a difference of 55. Flex is greater than planning. It's an expense, so that's unfavorable. But again, this just comes about because of that difference in activity. We serve more customers than expected, so we'd expect expenses to be higher or greater. Travel, $21,000 minus $18,000 is our $3,000 difference. Again, unfavorable. Now, other, 36,000 versus 36,000. Remember, we never have an activity variance for a fixed expense. Never, never, never. Because we don't flex them in the flex budget. We assume they're staying the same. And again, I'll do the total line here. 145,500 minus 137. 8,500, that'd be unfavorable. And then, of course, at the net income line, 29,500 minus 13,000. Got 16,500, flex greater than planning, so that is favorable. Or if you prefer, netting out our activity variance for revenue, and then our activity variances for the expenses there. So that wraps up the practice for Chapter 9. Again, revisit any you want some more time with, and let me know if you have any questions. See you next time.